January 2025. Treasury yields spike without warning. Repo rates separate from Fed targets by margins that shouldn't exist. Hedge funds quietly reduce leverage. And in the corner offices of primary dealers, traders watch their screens with the kind of focus that comes right before something breaks. Most investors see noise. Market veterans see something else entirely. The exact liquidity fingerprint that appeared 6 months before Lehman Brothers collapsed and 3 weeks before the Treasury market seized in March 2020. Here's what makes this pattern so dangerous. It doesn't announce itself with headlines or panic. It whispers through the plumbing of finance, through spread widening and settlement failures, and the microscopic seizures in markets most people never think about. By the time it reaches CNBC, the trap has already closed. The liquidity pattern isn't a prediction. It's a diagnostic. It measures the hidden stress building inside the financial system's circulatory system. And when that stress crosses certain thresholds, when specific markets begin moving in specific sequences, history says what comes next isn't a correction. It's a rupture. Right now in early 2025, those thresholds are being crossed. The sequence is underway. And the system that failed in 2008, that seized in 2020, has just started sending the same signals. Before we trace the pattern, you need to understand what we're actually measuring, because liquidity isn't what most people think it is. When traders talk about liquidity, they're not talking about how much money exists in the system. They're talking about the ability to convert assets to cash instantly, at predictable prices, without moving the market. Liquidity measures the friction between wanting to sell and actually selling. In a liquid market, that friction is invisible. In an illiquid market, it's catastrophic. Think of the financial system as a massive, interconnected network of promises. Every treasury bond, every repo agreement, every mortgage-backed security represents someone's promise to pay someone else. The system functions because these promises can be traded instantly, converted to cash the moment you need them. Liquidity is the grease that allows trillions of dollars in promises to change hands every day without seizure. When liquidity drains, the promises remain, but the ability to honor them disintegrates. A pension fund holding $1 trillion in treasuries discovers it can't sell $10 billion without crushing the price. A hedge fund with perfectly good collateral finds no one willing to lend against it overnight. The promises are real. The ability to act on them vanishes. This creates a paradox. The institutions holding the most assets discover, precisely when they need cash, that their wealth has become theoretical. They're rich on paper and bankrupt in practice, and when enough institutions hit this wall simultaneously, when the entire market realizes it cannot convert promises to cash, the system doesn't slow down, it stops. The pattern we're tracking measures the early stages of this stoppage. It identifies the moments when liquidity begins its invisible retreat, when the first stress fractures appear in markets that are supposed to be unbreakable. And it does this through specific, measurable signals that have preceded every major financial crisis in modern history. The 2008 crisis didn't begin with Lehman Brothers. It began 18 months earlier in the repo market, where the first liquidity signals appeared in plain sight. The repo market is where financial institutions go for overnight funding. You post collateral, usually treasury bonds or high-grade securities, and borrow cash for 24 hours. It's supposed to be the safest, most liquid corner of finance. In early 2007, it started malfunctioning. The malfunction was subtle. Spreads between repo rates and Fed targets began widening. Not dramatically, just a few basis points, the kind of movement most analysts dismiss as noise. But those basis points represented something profound. Lenders were demanding higher compensation for lending against collateral they'd accepted without question for decades. The collateral in question was mortgage-backed securities, pools of home loans, packaged and sold as A-rated bonds, used by investment banks to fund their operations. As subprime mortgages began defaulting, lenders started questioning what these securities were actually worth. They didn't refuse to lend, they just charged more, and then more. And then they started asking for haircuts, lending 70 cents against $1 of collateral instead of 95. By summer 2007, the repo market for mortgage-backed securities had effectively frozen. Lenders wouldn't accept them at any price. This created immediate catastrophic problems for institutions like Bear Stearns and Lehman Brothers, whose entire business model depended on rolling over billions in overnight repo funding. Here's what made this lethal. These institutions weren't just borrowing against mortgages, they were leveraged 30 to 1, meaning every billion in equity supported 30 billion in assets. When repo funding disappeared, they couldn't roll their debt. They had to sell assets into a falling market to raise cash, which pushed prices lower, which triggered margin calls, which forced more selling. The liquidity spiral had begun, but the warning signs appeared 18 months before Lehman collapsed. Widening repo spreads, settlement failures, where dealers couldn't deliver securities they'd promised, Treasury yields moving erratically as investors fled to safety, then back to risk, then back to safety in waves that indicated deep uncertainty about where safety actually existed. The Federal Reserve noticed. Internal documents show staff tracking these signals, noting the stress building in shadow banking. But the response was calibrated for a traditional banking crisis. Cut rates. Provide emergency lending to depository banks. The problem was the crisis wasn't in depository banks. It was in the unregulated investment banks and money market funds operating outside federal oversight, institutions the Fed had no authority to rescue. By September 2008, when Lehman finally collapsed, the liquidity pattern had been flashing red for over a year. The market knew. The signal was clear. What wasn't clear was whether anyone in power understood that this time, the crisis wasn't coming from where they were looking. March 2020 broke every assumption about how financial crises work. The pattern started the same way. Repo spreads widening, Treasury market volatility increasing, settlement failures rising. But then something happened that shouldn't be possible. U.S. Treasuries, the safest asset on Earth, became illiquid. When COVID lockdowns began, the initial market response followed the script. Investors sold everything risky and bought treasuries. Flight to safety, textbook behavior. But the scale was unprecedented. Pension funds, foreign governments, insurance companies, all trying to convert securities to cash simultaneously. And the treasury market, which is supposed to absorb infinite demand, started choking. Bid-ask spreads exploded. The gap between buying and selling prices, normally a few cents per $100, widened to dollars. Primary dealers, the 24 institutions authorized to trade directly with the Federal Reserve, were legally obligated to make markets in treasuries. But they didn't have the balance sheet capacity to absorb the selling. This wasn't supposed to happen. Post-2008 reforms required dealers to hold more capital and reduce leverage. These rules succeeded in making individual institutions safer. But they also meant that when the entire world tried to sell treasuries at once, the dealers meant to intermediate that selling were constrained by the very regulations designed to protect them. The treasury market seized, not because the assets were bad, not because of solvency concerns, but because the plumbing couldn't handle the flow. The safest, most liquid market in the world became the most dangerous, most illiquid market in the world. The Federal Reserve recognized the pattern immediately. They'd watched it unfold in 2008. They knew what liquidity seizure looked like, and they responded with overwhelming force. $1 trillion in Treasury purchases in 30 days, not to save bad banks, not to bail out failed institutions, to restore the basic functioning of the sovereign debt market. The intervention worked. Spreads normalized. Liquidity returned. The crisis was contained. But the speed required, the sheer scale of intervention necessary to prevent collapse, revealed something terrifying about the system's fragility. The reforms meant to prevent 2008 had created new vulnerabilities. The risk hadn't disappeared. It had migrated from bank solvency to market functionality. And the liquidity pattern that preceded this seizure, the widening spreads and rising volatility and settlement failures, appeared 3 weeks before the market broke. 3 weeks of warning that most market participants dismissed as pandemic noise. 3 weeks that, had they been recognized, might have allowed preparation for what was coming. Both crises, despite radically different origins, produced identical early warning signals. These signals cluster around 3 core measurements of liquidity stress. First, repo market stress. Specifically, the spread between overnight repo rates and the Federal Reserve's target rate. In normal conditions, this spread stays within 5 basis points. When it widens beyond 10, something is breaking in the overnight funding market. In July 2007, it hit 15. In March 2020, it spiked to 35. Right now, in January 2025, it's hovering at 12 and trending upward. This matters because the repo market is where financial institutions fund themselves every single day. When that funding becomes expensive or uncertain, institutions reduce risk. They sell assets. They cut leverage. They hoard cash. These defensive actions, multiplied across hundreds of institutions, become the liquidity contraction that triggers broader market stress. Second, Treasury market volatility, measured by the MOVE index, which tracks expected volatility in Treasury bonds. Normal readings sit between 50 and 80. Above 100 indicates serious stress. In October 2008, right after Lehman collapsed, it hit 245. In March 2020, it reached 165. In the first weeks of 2025, it crossed 120 and continues climbing. Rising Treasury volatility indicates that even the safest assets are experiencing unpredictable price swings. This forces portfolio managers to either hold more cash as a buffer or reduce positions entirely. Both responses withdraw liquidity from markets. Both responses accelerate the contraction. Third, primary dealer positioning. The Federal Reserve publishes weekly data on the assets and liabilities held by primary dealers. When dealers expand their balance sheets, buying and holding securities, they're providing liquidity to markets. When they contract, reducing holdings and refusing to warehouse risk, they're withdrawing liquidity. Leading into 2008, primary dealer Treasury holdings collapsed by 40% in 6 months. Leading into March 2020, dealer positioning in Treasuries was already at multi-year lows when the pandemic selling began, meaning they had no capacity to absorb the shock. In late 2024, dealer positioning began contracting again, and in early 2025 that contraction accelerated. These three metrics cluster together because they're measuring the same phenomenon from different angles. Repo stress indicates funding pressure. Treasury volatility indicates uncertainty about safe haven assets. Dealer positioning indicates the willingness of market makers to provide liquidity. When all three move into stress territory simultaneously, the pattern is active. But there's a fourth signal that's more qualitative: the behavior of sophisticated participants. The actions taken by institutions with the best information and the most to lose. And in January 2025, those institutions started moving in ways that suggest they see what's coming. Liquidity crises don't hit everyone equally. They hit in sequence, like dominoes falling through interconnected markets, and the institutions that react first are always the ones with the clearest view of system stress. In 2008, the first movers were money market funds. In August 2007, nearly a year before Lehman collapsed, multiple funds began refusing to roll over repo loans backed by mortgage securities. They didn't announce this publicly. They just stopped lending. But that withdrawal forced investment banks to find alternative funding, which they couldn't, which began the cascade. In 2020, the first movers were foreign central banks. In February, before COVID was declared a pandemic, sovereign institutions began liquidating Treasury holdings en masse. The data appeared in Federal Reserve reports weeks before the market seized. By the time retail investors understood what was happening, the professional exodus was already complete. Now, in 2025, the first movers are hedge funds, specifically macro hedge funds that trade based on liquidity conditions and arbitrage discrepancies across markets. Throughout late 2024, these funds steadily reduced gross leverage. They closed basis trades, unwound Treasury futures positions, and shifted to cash. Portfolio disclosure data, released with a quarter lag, shows this de-risking accelerated in December. Why does this matter? Because these institutions don't react to headlines. They react to price action and liquidity metrics that most investors never see. When a fund that runs $20 billion in leveraged Treasury arbitrage decides conditions are too dangerous to maintain those positions, they're not speculating. They're reading signals embedded in market microstructure, signals that indicate the risk-reward calculation has fundamentally shifted. The second group moving is primary dealers themselves. Dealer inventories of corporate bonds, municipal bonds, and mortgage-backed securities have all contracted over the past 8 weeks. These institutions are legally obligated to make markets. When they voluntarily reduce inventory, it means they're unwilling to warehouse risk. It means they expect volatility to increase and liquidity to decrease, making those positions dangerous. The third group, just beginning to react, is corporate treasurers. Data on commercial paper issuance, the short-term debt corporations use for working capital, shows declining volumes and rising rates. Companies are finding it slightly more expensive, slightly more difficult to roll over routine funding, not crisis levels yet. But the trajectory is clear. This sequence matters because these institutions are the liquidity providers of last resort. When money market funds withdraw, when hedge funds deleverage, when dealers reduce inventory, and when corporations struggle to access routine funding, there's no deeper pool of capital to step in. The Federal Reserve becomes the only entity capable of providing liquidity. And that means the system is one shock away from requiring intervention. The pattern says we're at the stage where smart money is positioning defensively. Not panicking, not forecasting collapse, but acknowledging that liquidity conditions have deteriorated enough that carrying risk no longer makes sense. And historically, the gap between smart money de-risking and public market stress collapsing is measured in weeks, not months. The liquidity pattern isn't predicting the future. It's documenting the mechanical process that precedes every systemic rupture. Understanding why this process unfolds the same way, regardless of the crisis trigger, reveals something fundamental about how modern finance operates. Financial markets function through continuous, instantaneous intermediation. Millions of transactions per day, each requiring a willing buyer and seller, a price both agree on, and settlement infrastructure that makes the exchange final. This process demands enormous balance sheet capacity from the institutions providing intermediation, the dealers and market makers who stand ready to buy what you're selling and sell what you're buying. Under normal conditions, these institutions earn tiny spreads on massive volume. They're not taking directional bets. They're providing a service, matching buyers and sellers, holding inventory temporarily, and collecting the difference between bid and ask prices. This model requires leverage. To earn meaningful profit on tiny spreads, you need to do enormous volume, which requires borrowed capital. This creates a structural fragility. The institutions providing liquidity to the entire system are themselves dependent on continuous access to overnight funding. They borrow hundreds of billions every single day in the repo market to finance their operations. If that funding becomes expensive or uncertain, they have no choice but to reduce their operations. They stop providing liquidity precisely when markets need it most. The liquidity pattern emerges because stress compounds through this structure in a predictable sequence. It starts with an external shock, something that makes investors nervous. Subprime mortgages defaulting, a pandemic shutting down the global economy, a geopolitical crisis, regulatory change. The specific trigger varies, but the response is identical. Investors begin moving to cash, not selling everything, just reducing risk at the margin. This selling creates price volatility. Volatility forces dealers to hold more capital against their positions, which reduces the amount they can intermediate. Reduced intermediation means sellers face wider spreads and worse prices. Worse prices trigger more defensive selling. More selling creates more volatility. The loop accelerates. Simultaneously, lenders in the repo market start questioning collateral values. If Treasury prices are moving unpredictably, if corporate bonds are selling off, if mortgage-backed securities are under pressure, lenders demand higher rates or larger haircuts to lend against those assets. This makes funding more expensive for dealers, which further constrains their ability to provide liquidity. At some threshold, the system tips. Dealers stop making markets. Bid-ask spreads explode. Settlement fails. And suddenly, assets that were perfectly liquid yesterday cannot be sold today at any reasonable price. The liquidity crisis has arrived. The pattern we track measures this process before it tips. Widening repo spreads indicate funding stress is building. Rising Treasury volatility indicates safe haven assets are becoming uncertain. Contracting dealer positions indicate market makers are withdrawing. These signals always appear before the system tips, because they're measuring the mechanical stresses that cause the tipping. And those stresses are present right now. The external shock in 2025 is fiscal. Deficit spending reaching levels that even Treasury market veterans consider unsustainable. Congressional dysfunction around debt ceiling negotiations. Rising yields as foreign buyers reduce Treasury purchases. These factors are creating pressure on the system's plumbing. And the plumbing is showing strain. So let's put it together. The repo market is stressed. Treasury volatility is elevated. Primary dealers are contracting positions. Sophisticated participants are de-risking. And the correlation between these signals matches the pattern from 2008 and 2020 with disturbing precision. This doesn't mean collapse is imminent. The pattern indicates rising systemic stress, not guaranteed failure. But it does mean the system's tolerance for additional shocks has narrowed dramatically. A year ago, markets could absorb geopolitical flare-ups, regulatory surprises, or unexpected economic data without breaking. Today, that buffer is gone. The mechanism that would trigger actual crisis is straightforward. A catalyst, something that creates sudden, massive demand for cash. A major default, a policy error, a geopolitical rupture, something that makes institutional investors decide they need liquidity now, not tomorrow. That selling hits a dealer community already operating at reduced capacity. Spreads widen catastrophically. The Treasury market, the core of the entire system, becomes illiquid. And the Federal Reserve is forced to intervene with overwhelming buying to prevent complete seizure. The difference between now and previous crises is awareness. In 2008, almost no one outside the Federal Reserve was tracking repo market stress until Bear Stearns collapsed. In 2020, Treasury market fragility was an academic concern until it became a market-breaking reality. But now, after two massive liquidity crises in 15 years, market participants understand the pattern. They recognize the signals. This creates a paradox. If everyone knows the pattern, if sophisticated participants are already de-risking, shouldn't that prevent the crisis? Not necessarily. Because the pattern isn't driven by ignorance. It's driven by structural incentives and mechanical constraints that exist regardless of awareness. Hedge funds aren't deleveraging because they're panicking. They're deleveraging because liquidity conditions make leveraged trades too risky. Dealers aren't reducing inventory because they're forecasting doom. They're responding to capital requirements and funding costs that make market making unprofitable. Money market funds aren't withdrawing from repo because they expect Lehman-style failures. They're applying slightly more conservative risk management to overnight lending. Each decision is individually rational. Collectively, they withdraw the liquidity that keeps markets functioning. And once that withdrawal reaches critical mass, awareness doesn't prevent crisis. It accelerates crisis, because everyone tries to de-risk simultaneously. The final question is intervention. The Federal Reserve stopped 2020's Treasury crisis with $1 trillion in 30 days. That precedent established an implicit guarantee. If liquidity seizes, the Fed will provide it. This guarantee creates moral hazard. It encourages risk-taking by institutions that assume they'll be rescued. But it also means that when stress appears, when the pattern activates, market participants expect intervention. January 2025 signals are being watched by every macro fund, every Treasury desk, every central bank research department. They see what's building. The question isn't whether the pattern is real. The question is whether the Federal Reserve will intervene early, before the seizure, or late, after the damage is done. Because the pattern, once active, doesn't reverse on its own. It requires massive